Profits through the roof, boot camp, pulling up, show them every move. Living ain't an option, hustle hard and never fake. Weekends are legends, don't even take a break. No recordings, live and direct. Trading warriors, future bosses, all in a lens. Swing trade, day trades, long clothes we feast. Michael G the beast, turning students into priests. Boot camp warriors in the room, Hunger Games commence. Knowledge is our weapon, trading no nonsense.
GM. Weekend Warriors, welcome to Weekend Workshop. All right. G fucking M. How are we all today? All right. Let's fucking go. Today is Saturday, is the 5th of October, and this is maybe my favorite stream of the week. Although it's like asking for my favorite child. I am a big fan of the Weekend Workshops, though. And this one's going to be a banger. Trend trading using moving averages. Fucking GM. If you're new, welcome. The Weekend Workshop lessons are live Saturday, and they remain up during Sunday. After the weekend is over, they are gone. And so you must see it. If not now, then right after. You've got 24 hours after it. What I do is I take a different topic each week that you guys get to vote on, and I go deep dive on it, giving you some alpha lessons as we go. This is G. All right, so without further ado, let's get right into it, because no time to waste. So, today's Weekend Workshop is trend trading with moving averages. I will first explain what moving averages are, although I have lessons on that, but I'll give a little bit of a preamble to it, and then we'll get right into it, of exactly how to use them in trends. In this workshop, I'll be showing them only in uptrends, just because that's the way it's set up, and it's just the easiest way to record the lesson. However, everything that we talk about here applies exactly the same in reverse. Most people, or many people at least, I would say, only trade long. And maybe not most, but many of you only trade long. Some of you only trade spot for religious reasons or restrictions in your location. You can't short, you can't use leverage or futures. So it's best to cover it with long. And of course, Bitcoin, crypto. Where does it go up or where do you make the most money? When it goes up. So we're going to only cover the long side, but for anyone who isn't aware, all of this stuff applies equally in the opposite direction. You just change you just invert the chart essentially, right? Good, cool. So, before I get started, anything major I need to cover? No, that's it. I think that's it. Let's fucking go. All right. Welcome to Weekend Workshop number 10. Oh, no. Almost forgot. If you have a question about the lesson while the lesson is ongoing, drop it into live questions, which is now open. Only questions about today's lessons, only about trend trading with EMAs. I would suggest that you don't ask the question until you've seen the lesson, because I'll probably answer it in there. So as it's going along, note something down if you want to ask it, and then I probably will cover most of it, but at the end, I'll answer any questions that you have. Okay, cool. First, a couple of things before we begin. Moving averages versus EMAs. I have a lesson on this in the Learning Center, explaining what a moving average is and explaining what an exponential moving average is, so I'm not going to explain them. But there probably would be a question from many of you, do I have to use EMAs? No. I just use them specifically for the type of trend trading I do. I use EMAs, exponential moving averages. the 50, 100, 200. The bands as well, the Michaels EMA, the bands, the 12, 21, go green and red, they're also EMAs. Is there anything special about EMAs? No. Could you use MA, simple moving average, as it's also otherwise known? Absolutely yes. No reason why you couldn't. So the way, as with everything, the way you'll figure out what works for you is by testing it. So if you want to try out regular, simple moving averages, go for it. Second, why moving averages themselves? Well, the reason why you would use moving averages is really three. Well, there's more than three reasons, but I'm going to just narrow it down to three reasons. Mostly based around liquidity assumptions. So, what is the point of a moving average? Point of a moving average is to give a smoothed line that follows price, right? So it takes an average, as the name would suggest, takes an average of the past X number of periods, candles. So if you choose 50, it looks at the last 50 candles, gives you a average price, and then it plots that on a chart and smooths it out so it looks like what you see on the screen. The liquidity assumption is the most important part for me, because you have different people and different players who will be using those levels to enter or exit trades. So the first most common, probably, especially these days, are algorithms, algorithmic strategies, automated programs. Essentially, an automated program that is set by an individual or an institution to buy or sell at and when the condition is met that it hits a certain moving average. So you can always guarantee there is some liquidity at major moving averages. By major, I mean the big ones. 50, 100, 200 are very common. 10, 20, 5, round numbers would tend to have the most because they're the most commonly used. Same as if price comes to a round number level like 30K, you can expect probably there's going to be more resting liquidity, more orders waiting to buy at exactly 30K than there is at 31,562. Just the nature of how people are and the nature of how automated programs work is they tend to cluster around well-known areas. Obviously, moving averages are dynamic, so they do not stay at a fixed price. And so whatever price it is at, whenever it's hit, orders will be executed. So that's the assumption you make. That assumption, I am extremely confident in saying that is the case. You don't always get a bounce off of every single moving average you could think of. That just wouldn't make sense. But the reason why moving averages tend to get reactions and, greater than a random chance, let's say, not every single time will it bounce off the 50, but there is a greater chance of it bouncing off the 50 than there is of it bouncing off some random area before or after, because of liquidity. That comes from algorithms. That also comes is for psychological reasons. So from individual traders, manual traders. There is a self-fulfilling prophecy with moving averages in a trend, meaning markets going up or down. Moving averages are pointing up, so they're rising or falling, and they are in bullish order. So if you're using multiple, like 50, 100, 200, they are in order, 50 above 100, above 200. The psychological aspect there is people want to buy pullbacks in a trend, and one of the first places they will look is towards those moving averages. If you're not going to look at horizontal support and resistance, the next most common thing would be moving averages, probably followed by Fibonacci retracements. If you're just looking at, in a pullback in a trend, what levels are people going to look at to buy? Horizontal support, resistance, moving averages, and fibs. But in a trend, there can actually be a greater tendency for the moving averages to provide reactions rather than a horizontal support and resistance, for the very simple reason that a trend makes higher highs and higher lows. So if you look, for example, on this chart, horizontal support would be down there, right? That's the lowest point. So you would always look at the lowest point for a retest. So price moves up, and then the bands go into bullish formation here, 50, which is purple, above 100, which is red, above 200, which is the turquoise blue. So now it's bullish. If you're waiting for a horizontal support retest, you're probably not going to get it because it's a trend. A trend should not go all the way back. So then you have the question of, well, do I take this horizontal support or this one or this one or this one? And that's why in trends, quite often you can see a much simpler area that can get more consensus and end up creating a price low if it's a uptrend, a higher low, or a lower high if it's a downtrend, is the moving average. Because they are dynamic, it offers dynamic support and resistance. As price pulls back during this trend you see, there's not always good reason as to why it would form the higher lows where it does before moving up. Sometimes there's a sort of horizontal support, other times there's not really, other times it's just kind of moved above, came back below. But what it does find, and it seems to particularly respect in this example, is the 100 EMA on the 4 hour. All right, so psychological reasons. Self-fulfilling prophecy, right? People think they work, so for long times and in many market phases, they do work until they don't work. That's how trends are. You look in hindsight, right? Look back at any trend where the market goes higher or lower for a significant period. Stuff like moving averages works and works and works and works, and then it stops working. And that usually is the end of the trend. So the idea of this is not that they're magic. They are far from it. They do not predict anything. However, if you use them consistently over time, you can find an edge because they will work for long enough periods and they will produce enough results if you build a correct system, and it's got plus EV, that even when they stop working, that's fine because you made money when they were working. It's not about getting something that works forever. Get that idea out of your head. Nothing works forever. And everything I talk about here performs terribly if the market's not trending. Right? Obviously, you don't want to trend trade if it's not a trend. So this stuff will not work whenever the market is not trending. But the whole point of it is to trade the trends. So, psychological. So we've covered algos, covered dynamic SR, psychological entry, or psychological reasons, I would say as well. Entries. So people want to buy in a pullback in an uptrend. They want to buy. They have to buy somewhere, so they choose to buy the EMA. Right? Simple. Take profit. You'll have shorts. So there could be shorts who are shorting from here that might want to take profit at the EMAs. Anyone who was watching in Swing Trader chat when I was in the Sui short that I took yesterday or 2 days ago or whatever, or 3 days ago or fucking 6 weeks ago, I don't know. The days are all meshing into one. My target was a EMA. There was 100 EMA on the 4 hour. So I was in a short, so I was shorting above, and my target was to close the short, or part of the short, when it reaches a certain moving average. People will do that. So what does that create? Liquidity. And it creates a reason for it to potentially bounce. And so entry, people want to buy it. Take profit, people want to close their positions there. And also you could have some people taking profit on a long. So that would be like a short. If someone shorted here, they might take profit at one of these areas here. Or if somebody's long from the bottom, they might want to take profit at these levels. Not exactly sure why, because later in the lesson you'll see that you shouldn't really take profit there. You'd probably want to wait for them to cross, but whatever. Excuse me. And finally, stop losses. This is a very, very useful way to view moving averages in an uptrend and why they work or why they can work at certain times. A lot of times traders who may be long from here will be trailing their stop. So it's going up and up and up, and they entered originally at 31, but now it's at 41. What do they want to do? Well, they want to lock in some profits if they're going to sleep, if they're going to be away. They don't want to get stopped out on a big massive nuke that goes all the way down. So they trail their stop loss and move their stop loss essentially along with the moving averages. And quite often they can dive down and attack those areas because there'll also be stops resting. So all of this is just a way to explain that there is liquidity. Liquidity just means there are orders, buying and selling, bids and offers, limit orders, and people want to transact around there. The market loves to go to areas where there is liquidity. The market exists to facilitate trade. That's why every market that has ever existed in the history of mankind has existed. Whether it's a fish market or a financial market. Markets exist so I can come together and buy or sell from you. And you can buy or sell to me. Or from me. That's what fucking every market's always been about. So naturally, markets want to go to where there is liquidity. These are areas where liquidity exists. All right, enough on that. Next one, time frames. This is just a bit of a disclaimer. Everything I do is just what I do. You can choose any time frame you want. You don't have to do the exact same time frames that I do. Just because I'm doing 50, 100, 200 doesn't mean you have to. Also, it doesn't mean, feel free, right? Go for it. If you think that because I use it, it works better and you want to try it, great. That makes sense. I probably have more experience than every single person here, so I guess you might want to do that. However, I don't think anyone should listen to me just with no independent thought at all, right? You're here to learn how to be a trader for yourself. So make sure that you're always trying to test everything. I don't care if every single person in the campus uses 50, 100, 200. If you do, I don't mind. As long as every single one of you has tested that yourself in your own way, on your own time frames, on your own assets, different coins, whatever, and you've built a system that works for you. And similarly, if you want to use the 20, 60, and 80, completely fine. Just test it again, all right? The goal is simply to find plus EV systems. That's it. And with that, time frames both for the EMAs, so it doesn't have to be 50, 100, 200. It could be anything you want. It also does not have to be the daily chart, the 4-hour chart, the 1-hour chart, the 15-minute chart, the 5-minute chart, and the 1-minute chart. They're like the time frames you see me using most often. You do not have to use those. You can use a 2-day chart if you want. You can use a 12-hour, an 8-hour, a 6-hour, a fucking 3-hour, 2-hour, 12-minute. Who cares, right? Again, find what works for you. And that's all part of the process of discovery. Also, as I say every time, and I should say here, as I remember to mute that in case some fucking alert goes off. If you're a white belt, this does not have to, nor will it make sense for all of you. Don't worry. This is beyond white belt level, so you don't have to turn off the screen and stop watching. But don't expect this to work or not work or make sense or whatever. Stick with white belt. As soon as you get through white belt into blue belt, you will be able to do all of this stuff. So take your notes, keep them on the side, but stay focused on white belt when you're in white belt, okay? Very, very, very important. Blue belts, you'll also know, if you look down on the bottom left of the screen with the top G Apu in his blue belt, there is also Swing Trading Masterclass, which many of you, probably all of you blue belts have already watched or seen. That has very similar setups and lessons and ideas and system ideas, but different. So if you want more ideas, they're over there. And anyone else, when you get to blue belt, you'll also have additional lessons that are exclusive, 5 lessons exclusive to blue belts and above for swing trading. But what you're going to see today, every single person, has never been seen before. This is not in any other lessons. This is not in any other part of bootcamp. This is entirely brand new. Okay, with that out of the way, let's go. What are the elements of a good system? So when trading with moving averages in a trend, I am a fan of having at least 2 time frames, right? You don't have to, and I'll show as we go that you don't have to. And to begin the testing process of any system, as you should know from whatever stage of bootcamp you're in, but if you're certainly past the latter stages of white belt, you'll know that a fewer number of rules, simpler is better. So my advice would be start with 1 time frame. If you are going to start off with the 4-hour and you're testing the 50, 100, 200, start with the 4-hour. Get an entry rule. Okay, I enter when the bands cross. So when the 50 goes above the 100, above the 200, I enter. I put my stop loss below the swing low. I exit when the 50 and the 100 and the 200 cross bearish. Start as simple as possible with just 3 rules. Entry, stop loss, take profit. Then you build upon that and you change one thing at a time to build upon it. You don't change more than one thing. If you're doing any type of testing, say, imagine like product testing or any type of scientific testing, if you change more than one variable from test to test, then you don't know what the effect is coming from, right? If you change 3 rules, all 3 of them, then you're not even able to compare system A to system B because it's just entirely different. You've changed everything about it. But if you took a system and you'd 1 entry, 1 stop loss, 1 take profit, you tested that 100 times, then you went back and you just changed the take profit, then you can compare system A with the same entry and stop, system B with the same entry and stop, but they have different TPs, and you can see, okay, which system, which take profit performs better. That would be the optimal one. Okay, so change one thing at a time. That also includes time frames. If you're going to switch from using the 4 hour to the 4 hour and the 1 hour, which is called a secondary time frame, do that by itself just once, just that. And then a tertiary time frame, which means third. A third time frame, which is optional, is like having an extra level for essentially tighter entries, right? You get an earlier signal to get a tighter entry, increase your potential risk reward, and hopefully your EV as a result. Again, if you're adding that in, that's equivalent to adding a new rule. So do not just go from 1 to 3, right? 1 to 2, 2 to 3, one rule, one rule, one rule. Yeah. So the elements of a good system: primary time frame, secondary time frame, tertiary time frame, optional. I mean, secondary time frame is also optional, so I guess I'll put that in there just to be clear. Just to be really clear. You do not have to have those, but you're all probably going to want to when you see the rest of the lessons. Number 4, market structure. This should be number 1. However, in trend trading with EMAs or moving averages, I don't have a problem with looking at the moving averages first. But market structure is always the base of every system I use, because no matter what you're doing, you have to be able to say, how do I get in? So you can actually use moving averages just themselves. You can say the moving average, when they cross over, so the candle close that confirms the crossover, equals entry. Okay. But if you want to have an invalidation, a stop loss, you're probably still going to have an understanding of market structure. You're going to choose an interim low, a swing low, whatever. You're going to choose some point on the chart that if it goes to it, it is no longer trending. Remember, this is all about trending. So how does a trend end? When the swing low or the swing high, if it's an uptrend or downtrend, breaks. So you still need to have market structure as a base of this, in my opinion. You can do anything you want, but I find that basically every single system improves or is simpler or is easier to run or is easier to understand or performs just better over time with market structure as a base. So fucking use market structure. Number 5, confluence. This is, adding things on to your system that may improve the performance of it. I'll talk about a few of those. Number 6, invalidation. Number 7, taking profit. So you'll notice that the elements of a good system for trading with moving averages is basically the same as the elements for any good system. At the core, you're going to have an entry, an invalidation, and a take profit. You're going to have a base of some type of market structure. And the difference here is just you're going to use specific moving averages to denote and define your trend, maybe some entries, or where you start to look for trades. So you want to first, in any moving average based trend system, you must first establish primary trend, right? If you don't have that, you don't have anything. So that's where you have to choose a time frame, let's say the 4 hour, and you choose your moving averages, let's say the 50, the 100, and the 200. This is when your trading actually begins, or you're looking for trades. That, in this example, would be over here, right? So the 4 hour, even though it's gone up, the 4 hour trend is not bullish, not bullish, not bullish, not bullish, not bullish, until here, where you have the 50 and the 100 and then the 200. So when the 100 crosses the 200, you have them all in line. So at that point, this is where you now have a primary trend established for you on your time frame. Your primary time frame is your highest time frame for that system. It's not the highest time frame you ever use. It's the highest time frame for your system. That could be a daily, a 12, 6, 4, 1, 15 minute, who cares? Doesn't matter. It's all about what you're doing, what you're trying to achieve, whether you're trying to position trade over months, whether you're trying to swing trade over days or maybe weeks, whether you're trying to day trade, intraday, and so on. Next. You ideally want to buy or sell the first touch of each band. So this is ideally, right? And the logic being that when you have a primary trend established, the first time it touches the first band is when you want to look to enter. because that is the earliest possible point at which you could get a trend continuation from your specific time frame, right? There has been no, if you're using the 50-100, there's been no tests since they crossed bullish. There were no tests of them until here. Now in this example, it does not go to new highs. It actually ends up going to the 100 before doing that. That's fine. I'm not talking about this is the best system. I'm saying that the logic should be, in a trend, the first touch of each level, each band, is the best. Just like a support resistance, the first touch of support, the first touch of resistance is going to be the strongest. And each subsequent touch or test, you expect the market to potentially weaken and break through, right? So here is an example with SUI showing a primary, secondary, and tertiary. What you're doing is you're looking for the first retest after the new primary trend is established. What was that here? Market is not bullish. There is no bullish formation on bands. We move up. There is 50, 100, 200. You look at this area as your first retest, and that's where you want to look to do business. That's when you're starting to look for your rules, whether it's for entry or whatever. So typically, if you're going to use multi-time frame, right, primary, secondary, tertiary, or just primary and secondary, I want to make this clear. You do not have to use 3. Start with 2. If you're going to go beyond 1, start with 2. So if you're going to use primary and secondary, the idea would be when it hits your primary trend. So set an alert on the chart. This is very simple. Once you know your primary trend, let's say it's the 4-hour, you just go here and you add an alert. And you add alert to your EMA or your moving average for it crossing or touching the first one. So in this case, the 50. You will then get an alert on TradingView and it will say SUI has touched, SUI crossing 50 EMA 4-hour. Then you open up the charts and you go in and you get to work. Now you're looking for entry. If you are using secondary and tertiary, this is where you drop to lower time frames to look for confirming signals to enter based on the higher time frame, primary touch with a secondary or tertiary entry, right? Typically, your invalidation is going to be the next band down or some type of confluence or market structure, right? If you're just, which I suggest people do, if you're just testing right away where you're going to say, okay, I'm going to find a primary trend, I'm just going to put an order on the 50 and I'm just going to buy the 50 with a stop loss at the 100. So how that would look, if I go back over here, it would look like this. So if you are here, why not start with this? Instead of trying to make it really complicated, just start with this. This takes a bit more, playing around when you're actually live. You're going to have to move your orders quite a bit because obviously the moving averages are moving. So you need to be semi-active if you're doing this live. But what that means is, what happens if, so this is your good starting point, what happens if I buy the first touch of the 50 with my stop loss just one tick or just as low as you can get right below the 100? And then, figure out your own target. This is not about the target. But that logic, if I'm going to buy the first touch of the 50 in a primary uptrend, my expectation would be that could hold and take us to new highs. So maybe your target is new highs or you wait for weakness above that, whatever, right? So in that instance, all you would do is just keep moving that. So as the market moves along, it's gone past it. Sorry. Went a bit far. Here we go. You would just be moving it and moving it and moving it, and you would set the moving average and set your order there. Your initial invalidation is below the 100. The second band, just one band lower. So now you can position size correctly. You wait, and it hits, right? And it fills, and then you let it play on, and you'd be expecting the market to go to new highs, right? And then you leave it so that when it gets back into profit or when it gets to moving towards the target, you could update where your invalidation is going to be. You don't really have to because you're going to have a fixed position size. But when I say update, you would move it up in line with where the moving average is now. But it's easier to just leave it like this for the purpose of testing. Wherever your initial invalidation was, it remains there. And your expectation is that the market would move to new highs or wherever your target would be. So if you actually just bought the 50 EMA touch here and you actually just put your stop below the 100, and you did nothing else and just waited for it to go to a new high, it would have won. Even though it went all the way down, even though it came up, even though it actually hit the 100 and went below it, because of the dynamic nature of moving averages as they rise, this trade would have never got stopped out, would have went to the target one. So why not test that really simple one first and then go from there? You know, why overcomplicate things if the really simple stuff is going to work? So anything beyond that, if you're going to not just buy the 50 with a stop at the 100, you're going to do something different, then you're trying to build upon that. You're trying to add some form of confluence to get, hopefully, to get a better result. Right. So in your primary trend, we're looking back here, we got a primary, secondary, and tertiary. So the simplest way for using multiple is this. You find your primary trend, okay, which is over here on the 4 hour. Bands cross, they're bullish. First touch, here we go. But you don't do anything here. As soon as price touches the first time, you're looking at your other signals. So in this example, there's primary, secondary, and tertiary. As soon as price hits on the 4 hour, you go and look at the 1 hour chart at the exact same place. And what is the 1 hour chart doing? The 1 hour chart is also bullish, 50, 100, 200. So this can be a set of rules. This is literally a system idea. If price hits the 4 hour with the bands bullish, and price is on the 1 hour still bullish, and then I go to my third time frame, my tertiary, that will not be bullish, that will be bearish. And the entry is as soon as the tertiary turns bullish, provided that the 1 hour secondary and the primary are both bullish. So when price hits, you have a bullish 4 hour trend, you have a bullish 1 hour trend, but you have a bearish 5 minute trend. If you wait for the 5 minute trend to flip bullish, which it does over here with the cross, 50, 100, 200, that is your entry point. As long as you look at the 1 hour, is it still bullish? Yes. The 4 hour, obviously, yes. Then you get in, place your stop loss at the lows or wherever you deem to put your stop, one band lower, again, up to you. And that's your simplest way of using multi-time frame, primary, secondary, tertiary. That's the easiest way. Why does that work? Lower time frames build into higher time frames, right? You can't have a 1 hour uptrend without also having a 1 minute uptrend. Right, the 1 minute has to go up first, which then will build into the 5 minute, which then will build into the 15 minute, which then will build into the 1 hour, and so on and so on and so on. So if you work that backwards, if you have a pullback on the 4 hour, what's that going to be? This is not a 4 hour downtrend because the bands are still bullish. This is not a 1 hour downtrend because the bands are still bullish, if we're using the bands as a proxy for trend up or down. But it is a 5 minute downtrend. So from the top over here, pretty much all the way down, the 5 minute chart was in a downtrend. And probably the 15 minute chart was as well. So when you get to that test, and again, nothing matters here. This doesn't matter. None of this matters until it touches the band of the primary trend. So you're looking at this. Oh, look, it bounced here. Should I get long? No, you fucking shouldn't. That's your secondary time frame. Doesn't matter if it touches there. Don't try and trade every move on the chart. Primary trend. You wait. Primary trend hits the bands. That's when you kick into action. Is the secondary bullish? Yes, it is still. Is the tertiary? No. We wait for the tertiary, M5. Once it goes, boom. That's your entry, okay? Super simple. Next, market structure. All right. So, using market structure as a entry trigger or confirmation or confluence along with your moving averages. This is something that many of you will do naturally anyway. You will wait for the bands to get hit and then you will wait for a market structure break to signify a reversal. But what you do first, remember, the essence of good trend trading is your primary trend. You have to pick a time frame. You have to do your testing with a primary trend. I am trying to catch big swing trades that last for weeks. Okay, your primary trend should probably be the daily chart, like it is here on Solana. So what's happening? It's in a daily uptrend. It has not touched the EMAs yet. So they crossed here. No touch, no touch, no touch. But it's going up, obviously. Higher highs, higher lows. Uptrend, uptrend, uptrend. Then it stops, comes back, comes towards them. Doesn't quite touch them, but does touch the EMA for the first time over here, then what you're looking at is your secondary trend, right? Where you're looking at what happens with the market structure. So price comes down and touches the daily 50 EMA first over here, right? At this point, as you can see on the left, the biggest chart. However, at the same time, let me see here, 1 second. As we have a very, very fucking slow. I don't know why TradingView is so laggy. Here, the reason why you would not buy blindly that first touch of the daily on Solana there is because the 1 hour trend is bearish. So the 1 hour trend, the bands are crossing. The 1 hour trend is bearish on a market structure basis. And you then take your secondary, secondary, which is your 8 hour in this example, and you mark out your market structure. So you don't take the first touch because the structures are bearish and the bands are bearish on the lower time frames. It then goes down into new lows. And at that point, you're looking here at your market structure based on the last high before the lowest low. And you're waiting for a market structure break above there, which occurs at that point. And you can also look at your lower time frame, your 1 hour, for a trend bands cross confirmation, which also happens around the same area. And that's your confluence. Like, that's your system, right? So primary has to hit the level. Secondary has to have a market structure break, meaning if it was happening this first time when Solana hits the band here, you'd be looking at the secondary trend and saying this needs to break above this high. If it doesn't, you don't do anything. Price goes lower. Price goes lower. You have a new market structure level. Breaks above it. You get a candle close. You look to your tertiary